Good morning. Again, I'm Denny. I'm your Director of Accounting and General Accounting. And just a little quick background. I've been with the university since November and looking forward to working with everybody. My background is in government auditing, so I spent the past, before here, about 12 years auditing cities and counties, so that's my world. And Laura Coletti will present the section on management reporting, so she's going to be joining me in just a little bit. So the agenda for this section is the financial statements. I won't go into too much detail, and Laura did present it to everybody, the statement of net position. Sorry. Maybe it's my voice that's doing that to... Laura will go over the management reporting, and then I'll return with financial schedules. We'll go over monthly close and fiscal close. So on the financial statements, I'm going to start with some GASBs. And then my first question for everybody is, are there any other GASB nerds in the room? How many? Okay, I'm not alone. Thank goodness. I'm just going to lay the foundation for this right here. This is OP's financial statements. It's about 100 and some pages, has independent auditors report in it. I'll try to continue. If I echo, I'll just step back. Can everybody hear me okay from here? Okay, I'll keep this distance. So I'll start with GASB 34. GASB 34 basically lays the foundation for the basic financial statements. It reads basic financial statements and management discussions and analysis for state and local governments. So this doesn't directly apply to us. It kind of more lays the foundation for states and local governments, so counties and cities directly follow GASB 34 in terms of preparing this right here. It basically says you have to have an MD&A, your basic financial statements have to have your statement of net position as part of your government-wide financial statements, and then it has to have your government fund financial statements, which focuses on current financial sources and uses. So that's GASB 34. Then it also lays down some groundwork for RSI, required supplementary information. GASB 35 is basically amends GASB 34 and says that if you are a public college or university, go ahead and follow GASB 34. So 34 doesn't specifically apply to us, but GASB 34 then comes in and says, now you go follow GASB 34. So just to go over some recent pronouncements, GASB 68 and GASB 75 basically brought on those net pension liability, the pension liabilities and the net retiree health benefits onto the financial statements. And the background for that is basically we're here, we have a pension that we expect to get in the future. So GASB is kind of saying, is that a true liability? Is that something that you have to pay for in the future? And the answer is yes, you're going to have to pay for that in the future. But is it really linked to the current? Is it current or is it future? So to bring it onto the financial statements basically paints a better whole picture of what the true liabilities are for the university. So 68 outlines the accounting requirements. It describes how you calculate it. It takes into the assumptions of the discount rate of the investments. It takes into account, your age. It actually, there's a census data with employee information on the age, years of service, when the expectation to retire, and then they build in assumptions of how much longer you're going to live after you retire, and then they calculate that to give you your total pension liability. Take into account investment earnings, expenses, things like that. So that's how you get to the number that's on the financial statements. That's really, really huge. And then I'm going to talk a little bit more about GASB 87. So this is going to be a big one that's coming down. Sorry. Yesterday I had to step out for about an hour because OP with all the campuses are having meetings and discussions about acquiring a lease accounting software that's going to help us implement GASB 87. So for everybody here, think about that copier that you have in your office. Think about anything that you're renting. If you're renting office space, think about anything that you pay to use an equipment and asset that you don't own. And GASB 87 basically says that they're going to take away the difference between capital leases and operating leases and turn it into one financial reporting model. And it's going to say that if you are paying to use something, once this is implemented, you're going to be recording a right-to-use asset, which is an intangible item on the financial statements, and then associate a liability for it. So essentially, you're grossing up your assets and your liabilities for it, which won't have a net effect on your bottom line, but it requires you now to record it even if you're renting an office space. You're paying for that. Keep in mind that if it's less than a year, we're not going to worry about it, but if it's more than a year, that's when you want to consider recording the right to use of the asset. So think about that as we continue to move forward with securing the software for this. It's going to basically take an effort from everybody. Everybody's going to be involved because we're all going to have to update that system to make sure we capture all our leases, all the things that we rent that go beyond 1 year. So GASB's been busy. They're up to 90 pronouncements now, and the 90 pronouncement talks about majority equity interest, and I'm not going to go into details on that. But, very basic high level is that if any entity has a majority equity interest in a separate legal entity, like if a nonprofit has been created, if you own majority of it, technically that needs to be included in your financials as a component unit. So that kind of stuff. So I won't go into any more about GASB's because I use it to sleep and I can't sleep. So to go over OP's financial statements, I just want to highlight a few points. The main components of OP's financial statements are the management discussion analysis, the statement of net position, and the statement of revenues and expenses and change in net position that Laura introduced yesterday. Also has the statement of cash flows, then you have your notes to the financial statements. All these are available on the website here. If you just kind of Google UCOP financial statements, it'll take you to that address right there. The things I want to highlight on here is that if you're going to read this, anybody read this? Anybody read this? All right, a few, okay. I read it once. The reason I read it was because I was applying for this job. I promise you I'll read the next one for a different reason because I'll read it. So I want to highlight the management discussion analysis. If you are not going to read this entire thing front to back, take a look at the management discussion and analysis. It's a high-level overview from management's point of view that describes the changes in the activities that happened during the year. GASB 34 has prescribed the requirements of what needs to go into it, what do you need to explain, certain significant variances that you have to kind of add to this report to show that it'll give people a better picture of what actually happened. So if anything, read the management discussion and analysis. And then the next one I want to highlight are the statement of cash flows. Yesterday, Laura mentioned that if you extend credit, you have an AR and you have a revenue. You've recorded revenue in your income statement, in your statement of revenues, expenses, and changes in that position. Well, then the question comes is that, are you going to collect on it? Did you collect on it? So that's why the cash flow statement, in my personal opinion, is one of the most important statements of this whole thing because everybody knows that cash is king, right? You can record millions and millions of dollars of revenue, and if you're not going to get it, does it really mean anything for you? So that's why the cash flow statement of cash flows is very important. The notes to the financial statements, if you're interested in digging more into little details of what do we invest in, what are the activities of the fixed assets, feel free to kind of dig in and look up any areas that you're particularly interested in. Okay. So to highlight the Davis Annual Financial Report, I have here the 2017 version, and it pretty much mirrors UCOP's financial statements. But for 2018, we kind of really started thinking a little bit about who are the users, what's important. Majority of people didn't raise their hand about reading this particular set of financial statements, so do you really want to know at the Davis level all this information? So we condensed it and tried to highlight areas that we believe are more important for the users here, the people in this room. So it's going to be much condensed. We try to make it look more modern. The OP financial statements are GASB-based, it's consolidated for all campuses, it's for the purpose of compliance, so the things in there are very technical. And the users are, the state of California, we get state appropriations, so they hold us accountable by, getting an independent audit and producing these financial statements. For UC Davis, it's a standalone, it's a fully loaded picture of the university, gives you a snapshot at June 30 of what our position is, and summarizes the year's activities. And we try to target management, the users of these financial statements, or if you guys are interested in going through it. Fiscal year 2018 is not done yet, but hopefully in about a couple of weeks, we'll have it posted up on our website. And then the next section is management reporting. So Laura will come up and go over management reporting.
All right, thank you. So along with this wonderful book of information, we do produce a management report, and it's really for use by the senior leadership team. So about 3 years ago, we started kind of gathering information that we thought would be useful for the chancellor to know, the vice chancellors to know, and just in general, what the operations look like at UC Davis. So this, like Denny mentioned, is very technical. The management report is much more analytical. So it looks at usually about 3 years. There's some very quick snapshots that are in the front that kind of go over high level where we are from a campus perspective. We do include the medical center, so it's included in there. In some pieces, we exclude them so that we can see what the campus looks like. Typically, we don't do that because they're so integrated in what we do here as UC Davis as a whole, but in some cases, it makes a lot of sense to look at the medical center separately. So I'm going to take you through a couple of things that I think are relevant for this group to see. So this is the executive summary, and this is fiscal 18 compared to fiscal 17. And you can see and we've got 16 on there too. But you can see that gray bar. So this is really just the snapshot. This is the first page. This is what, we kind of go over high level what's going on. So you can see the revenues. We organize it by campus, medical center, appropriations, and private gifts. And you can see the fluctuations there. Where's my pointer? Right there. So you can see campus, we increase our revenues by 128 million, medical center by 74 million. A dip there in state appropriations, which if I were to show you the analysis portion, would show that that's really just a classification. And I don't know if many of you know this, but the state appropriations were actually reduced in fiscal 18, and we didn't pay the UCOP assessment. So it was just kind of an offset of those expenditures. Instead of them giving us everything and us paying it out to them, they just reduced our appropriation, so that it's just kind of a change in how it looks on our financials. And then private gifts. Investment income. So I'll point that out because I know we're going to talk about it later when we kind of wrap up the day. But investment income, including the fair market value appreciation. So we have about $2 billion of cash and investments, including endowments, that we manage from a university-wide perspective, and that includes the medical center. And so we're very active in making sure that we're earning the most money that we can for the university, so we can, drive growth and provide more investment income to, where we have shortfalls and things of that nature. So you can see, though, it's very volatile, right? In 16, we had $8 million loss there. Then it jumps up to 169 million. And while 125 million looks like a good number, it's down from 169. So the market is really unpredictable, and so we do our best to make sure that we're comfortable with the numbers we have and that we're investing wisely in the market. Again, compensation expense, so you can see just some of the numbers, and this is just kind of a big picture view. And then the decrease there, increase actually in net position for the year. I will point out again that the medical center is included in this, so when we break them out, actually the campus shows a loss for the year, and it's because of a lot of the investments that we're making in the campus. And then the medical center they're more of a business, and so they have more of a, I wouldn't say profitability target, but they do operate more in that respect, and they're planning for the future to build new hospitals and things like that. So One other thing I wanted to point out is while we come down to these bottom lines and the increase and decrease in net position from a technical perspective, as Denny mentioned, we have some pretty big fluctuations. You can see this OPEB and pension actuarial adjustments. So the function of those calculations and how to put those liabilities on our books every year, it fluctuates quite a bit, and a lot of that has to do with the investment returns. So it's very closely related. If we've planned to earn 8% on the investments, but then we earn 13% on the investments, then that drives a change in how our expense looks on the financial statements. So we actually pull out some of these non-cash items, if you will. Depreciation is kind of a non-cash item as well, but we look at it a little bit differently so that you can actually see the operations without some of those high non-cash entries or things that don't really impact the operations of the business, even though they will in the future. Does that make sense? Okay. All right, so just kind of bringing the budget and the accounting together, we also have what's called our management forecasting tool that is something that's owned by the budget office. But we help them in a number of different ways in analyzing the actuals, both in order to plan and forecast better, and also analyze how we did when our forecast. So I will point out in this circumstance, we pull out the medical center. They have their own forecasting that they do, and so we don't look at them in this same view. And then it's also not necessarily just the financial statement basis. We pull out things, so for example, we pull out depreciation. We don't need to forecast depreciation. That's not helpful. That's not where our revenues are gonna go. So we pull out depreciation and we replace it with things like capital equipment expenditures, so things that we're actually gonna spend our cash on for the year. We also put in debt payments because we know we're responsible from generating revenues to have to pay those debt payments, and those don't necessarily flow through the financials from an income and expense standpoint, if you remember back to yesterday with our outflows discussion. These are just some of the key assumptions that are used in that forecasting. I'm not gonna go into them in a lot of detail, but just know that they're there. And then actually the tool, when you get into it, if you change some of these assumptions, it shows different forecasts. So it's really well put together and helps us analyze if things change in certain areas, this is how it's gonna look in the future. And this is a busy slide. I couldn't fit it in any other way. But this is really just the picture of our forecast. So you can see up there, here's the forecast that we ended up with, and that's again on that modified basis, and then the actuals for the year. So we had planned from a bottom line perspective to have about 3.6 million, which is almost close to break even. I think that's a little bit how we like to operate, right? We wanna know what our revenues are and be able to invest in the campus as much as possible. But when you look at kind of where we landed, we overspent, if you will, or under recovered the revenues there. Actually, not too bad. We were 16 million higher than we thought we'd be. But the $25 million, so there's a swing of about 29 million, which is pretty good on a big organization like this. So yeah, if you have less than 1% and about 1% on your expenses, we're doing pretty good. So, right, I'll turn it back over to Denny.
Okay, the next topic is on financial schedules, and I won't go into too much details. I want to highlight the main importance of financial schedules, and these schedules are the way that OP collects all the financial transactions that is used to prepare this report right here. So when you guys think about, how can my numbers impact this and how does it make its way here, it's through these financial schedules. And the important points of each of the financial schedules is that Schedule A is listed by current fund revenue by fund source and is prepared by sub-fund group. So the focus there is make sure your sub-fund groups are correct, your sub-fund group types are correct. It's going to drive this report. And then the other ones being account group code, uniform accounting structure. Schedule D is also sub-fund group. So going back to Jim's presentation yesterday and providing this overview, this picture, although yesterday's picture was much more nice looking compared to this because communications did a great job making this look pretty. And focusing on those UC accounts and UC fund numbers and making sure that those are accurate, it drives this. It makes putting this together a lot easier, and it also provides OP a way to evaluate all the campuses. So if you have the wrong subfund group, you put it in the wrong bucket, OP is taking that number, comparing it to another university, and they're gonna start asking questions like, well, why is this so different compared to another university? What's going on? Why is it different? Is it really just a classification, or are there truly things that's going on in operations that we need to kind of make decisions on to make better, and do we really have a real problem that needs to be addressed? So just want to emphasize that on financial schedules, the importance of that, and how it drives this report right here. It's available through our website. If you go to the Finance BIA website, it's under the financial reporting section, and there's a little box to the right for financial schedules. If you don't want to go through our website, you can also see the one that's been published by OP. So if you Google UCOP financial schedules, it'll take you to the webpage, and it'll show you all the campuses' financial schedules, and it'll also show you comparative. So it'll basically have each campus has a column, and then you can kind of look across and see how we compare against the rest of the campuses in the state. Okay. So the next one, let's go over very quickly monthly close. We put a little calendar together to kind of show what happens at each critical step. So your last day, your final day of the month is the last day to post cash and accounts receivable documents, the last day for department feeds. Then the third working day is the last day for all of the departments, KFS documents input for the previous month. Sixth working day would be your last day for central office. Seventh working day is notification from FizHelp that the fiscal period is closed and DS reports and ledgers review is available. So the eighth working day there is the day that files are sent to OP for consolidated reporting, which are the financial schedules. So if you look at the calendar and ignore the kind of the bullet points and you just focus on the calendar there, the eighth working day would be the 12th in this example month. So we're talking week 2, and then we work your way backwards. It doesn't always give us a lot of time, but at the same time, when you start looking at this and go, by the time OP gets this, 2 weeks have already gone by. So you're already halfway through the month. And so in order for financial schedules and financial information to be important, we want to make sure that it's timely. So that's why the emphasis for such a tight close deadline, and we want to make sure that we're on target. And that's for the purpose of making it important, consistency, being able to make decisions, making it timely. Okay? So moving on to the fiscal close, this is going to be a big part. From general accounting standpoint, from project management perspective, we use Teamwork. And Teamwork is just a project management software, and we have over 400 tasks loaded onto it. We take OP's key dates and we build it into Teamwork so that we have reminders for specific tasks that needs to be completed. And we have to coordinate that with other teams and units to make sure that things are flowing, we're following the timeline so that nothing really breaks and falls apart. And the reason for that is because the steps are dependent on each other. Some departments can't do things until some other department does things. And so we are all linked and connected when we do fiscal close. So we want to make sure that, when we say this has to be done, we have to close on a certain date, it's not because we came up with it and we just wanted to cause a headache and tell you guys, we want it right now. It's because we have to follow the timeline for other people to continue to do the work that will lead to a successful close. So here's a quick link to our fiscal close calendar. Currently, we don't have the new one. We get it at the end of April. So once we get it from OP, we'll publish it on this webpage. Okay, this is going to be a fun slide. I'm going to go over here, and I'm going to look on this report for the independent auditor's report. And the date of this report is October 12th, 2018. So if the independent auditors were able to issue this report, issue the independent auditor's report, how long do you think it took them to audit University of California? So you take the beginning of October and you work backwards. Who guesses 1 week, 2 weeks, 3 weeks? maybe a month. My guess is a month. It takes about a month to, longer? Oh, longer, okay. So, a month and a half? Okay, let's just say a month and a half. So we work backwards, a month and a half. That means that OP has to get all the schedules, all the footnotes, all like a draft of the financial statements ready for the independent auditors to start auditing. So if we start from October, working backwards to beginning of September is when OP has to basically be ready for the auditors. So from the end of August, beginning of September, they get everything, all balances available in DS for new fiscal year, or basically final balances into OP up there August 3rd. They start on that day to prepare for the independent auditors to come in to start the auditing. Then we work backwards. We have year-end closes up there for AFR, last day of July. And then we continue to work backwards, year-end closes for CAA, year-end for AP, payroll, student accounting, department, year-end access closes at the end of the day. We have down there in the middle, Dean's office, year-end closes. So we take OP's schedule and the deadline, we work backwards to schedule out what the deadlines are for each department. So the emphasis here is that we try to give everybody as much time as we possibly can. And because all this work is dependent on each other, we have to establish these strict deadlines so that each step can be successfully performed in order to meet the schedule. Any questions about this? Okay. My last slide. I know there's a boring section. Best practices are, to start off, review the monthly ledgers for accuracy and ensure all ledger reviews are completed. This is an important step, not just from the point of checking off a box. It's not checking off a box. It's making sure that each month you're reviewing your transactions and your accounts to make sure that they're accurate, so that way when you get to the end of the year, you don't have any surprises. It's probably gonna be a lot easier for you to remember what happened this past month versus what happened 5 months ago, 6 months ago. So I want to emphasize the importance of doing the monthly ledger reviews, and really don't think of it as just checking a box, to really go through those transactions and determine what the causes of those variances are and determine whether things need to be corrected or adjusted. We want you to subscribe to the FizInfo listserv, where we're going to send out important notes and reminders. So that way it's a way to kind of help you get it on your calendars. We're going to send out these friendly reminders that some steps need to be performed, so subscribe to that listserv. As part of the conversation with the chart of accounts, we ask that you review the status of accounts to make sure that there's still business need to keep them active or open. Yesterday, there was a question about how many accounts is too many accounts. Well, this is your opportunity to go through it, prepare for fiscal close, look at those accounts. If you use an account once a year, maybe you don't need that account. If you use it once a month, think of a business need to keep that open. And if you don't, consider consolidating that to a different account. That'll help with the fiscal close. It'll help with monthly ledger reviews. We want to make sure you review users in your Dean's group and make additions and deletions. We want to make sure people have the appropriate access to do the work, and we don't want people to find out at the end that they don't have the ability to perform a critical function. General accounting works very hard to make sure that tasks are completed so that there isn't a chain effect of things breaking. Okay, and the last thing was to review the fiscal close calendar on the finance website. Once it's posted, we'll send out some form of communication, let you guys know that's available, and we make sure that we have a successful close this year. Okay, all right, thank you. So Mike LeGrand is up next for cost principle review.
Hello, everyone. So I was asked to come just do a quick overview of cost principles, F&A rates, CBR rates, high level. We can do a lot of questions later this afternoon. I know I'm the last person between you and lunch, so I don't know if that's a good or bad. Just kind of the guiding principles. So as a university, we're covered under the Uniform Guide. So in 2014, they implemented 2 CFR Part 200. commonly known as uniform guidance. At that point in time, they took 8 circulars. So we used to be under OMB Circular A21, nonprofits were under A122, state and local governments were under A87, there's A133 for audits. So there are all these different documents out there for all the different recipients of grants. And the government decided, let's just all combine it all into one. So that's what happened back in 2013, and it was implemented in 2014. So what's it really do? It gives us what's allowable and unallowable. It tells us what's a direct and indirect. It really gives us the guidance. Obviously, agencies have specific rules beyond that, but it gives us an overall operating framework for taking the federal government's money. It also says that we work with the cognizant agency. We take grant money from many agencies, but we work with one cognizant agency to oversee our internal controls, our audit resolution, negotiation of the fringe rates, and negotiation of the F&A rates. So we work with Department of Health and Human Services, their Division of Cost Allocation, and to set all this up for the entire government to use. What also happened in the cost principles, they're really more guidance and tell us we have to have effective internal controls to maintain their funds, but they don't tell us what to do exactly with it, with the money. They don't tell us how you have to spend your F&A return. They don't tell you how you have to be structured. You just have to have a good structure in place to have effective internal controls to safeguard the federal funds that are coming your way. So what are F&A costs? Facilities administrative costs, also known as indirect costs, overhead costs. The names change in the industry throughout the years, but they're all essentially the same thing. It's not a tax, it's not extra revenue. The government decides that this is reimbursement for expenses that the institution has already incurred. So this isn't just an extra revenue for the university. It goes back to the fact that the government has said we are partnering with universities, partnering with nonprofit research institutions, and we'll pay our fair share of the facility-related costs, the overhead of administrating the grants, and working to make sure that they have state-of-the-art labs and be able to perform the research. So these are real, true costs that the university has incurred. But again, from the previous slide, they don't say we have to use the indirect cost that was returned to us to only pay for these indirect costs. So there's not a one-to-one match. We can use it for other investments because we fund the operation and maintenance of the university with other fund sources. So there's not a prescription of how you have to use them. It's just they reimburse you based on your actual true costs of running the research enterprise or other sponsor activities or what other rates we have. And these are tightly controlled. There's a whole appendix in the uniform guidance on how to develop a university F&A rate. There's an appendix for nonprofit F&A rates. The one they haven't folded in yet is the hospital F&A rates. They have a holding spot for them, but they have not gotten it so far. They haven't brought those regs into the uniform guidance as well. So here's kind of a visual of really a little bit more describing what F&A rates are. COGR, AAU, APLU, and a bunch of other organizations started putting this stuff together a year and a half ago when the federal government started asking about, should we cap F&A rates at 10% for all institutions? The president proposed that, OMB was pushing it, and people really fought back. So, in a lab, the direct costs. What does it really take to do the actual research? But there's all the support costs associated with a research lab, a research facility, and this is just really trying to show it as a more graphical picture. It's a business, you need to pay for utilities. There's the library to store the information. There's the depreciation on the specific equipment or the high specialized equipment that we buy so they can do the research. So all those types of costs are considered indirect costs. And so I thought this was just one that the associations have put out over the last couple of years to put more of a, they talk about it in words and their overhead and indirect, but this is just really to more graphically show you what areas of a building or what areas of a university are being funded and reimbursed for that support the research enterprise. And then one of the bottom line, the bottom floor of this, is one that was really had to harp on because some of the testimony at Congress was, oh, they make it more expensive, or it's paying for their football facilities. But the part of the F&A cost allocation is it's only the space that's being, where the research is actually being performed. So the cost of your classrooms, the cost of administrative space, the cost of, dark, the gym next door, that is not included at all in the F&A rate calculation. That does not go to any of the research. So that was kind of the bottom floor, is not supporting the research, so that was trying to differentiate between what is real research and the stuff that supports research versus the other operations of a university, and those costs are not included in the F&A rate. So the F&A rate calculation. So we have indirect costs. The major cost pools we develop are general administration, which is central administration that supports the entire university, budget office, finance office, payroll, and like that. There's the departmental administration, which is from the deans down to department chairs, down to business offices throughout each of the academic units. Sponsored project administration, it's the pre and post award offices at the university. The research compliance, conflict of interest, animal care, IRBs, all the compliance areas that we have to do research. And then there's a student administration, but generally none of that goes to research. A few institutions do allocate that to research, but it's such a small component. And if you guys don't know, our administrative components are capped at 26%. Only universities have an administrative cap. Every other granting funding recipient has no cap, so it is a penalty that universities get. They can never get really full cost recovery from the government. So there's caps on our administrative side. So no matter how much we spend on administration, we could only get up to a 26% F&A rate for administration. So the real drivers is really the facilities. How much does it cost? What kind of buildings you have? And there's regional differences. It costs more to build in San Francisco or New York than Indiana. So across the country, you'll see differences. Public schools generally have a little bit lower F&A rates than private schools. We get tax-exempt bonds. It's a little cheaper for us to build than a private school who might just fund it themselves, or they get a different process. But really, it's the operation and maintenance is the biggest driver of the entire rate. It's expensive. The utilities for labs, it's the air handling, the constant cooling and chilling, heating, everything like that. So that's what really drives the rates. And then you take all those costs and you allocate to all the functions that they support. So we have to take the utilities and allocate it to every building. Every building that's under our utility grid. Which ones are on the chilled water? Which ones are on the steam? Which ones have electricity? Which ones has gas come through? And we figure out all those type of allocations. So this kind of simple thing here, my summary set of schedules I send to the government is 400-something pages long. And that's a summary level schedules. That's not the detail, that's summary schedules that they require for the submission. An institution this size, it is a year plus of just calculating numbers, and then multiple years of, they used to be about a year and a half to negotiate it, but there's a little bit of staffing issues at the federal government level. So I just talked to Berkeley this week. They're coming to negotiate next month, and they've been working on it for 3 years. It's like a 3-year delay for them. So instead of, there used to be about a year metrics that they would try to get to negotiate rates for institutions, now it's getting closer to 3 years, which is kind of a disservice that the government's doing to institutions. Well, how does it really work? So you have their indirect costs as a pool, and then you have your direct costs, the total cost of our research. We have a special rate for the Primate Center here. You can do an instruction rate, other sponsored activities, so it's not research, it's not instruction, it's service type of awards. And then you still have to allocate to the other institutional activities. We still have to allocate our payroll office, our general accounting, and our budget office to auxiliaries, to athletics. They consume the same financial system, so that we can't just say it's only focusing on research or academics. So they do get the allocations as well. And this is basically what it comes to, is what calculates an F&A rate. You take all the pools of the costs, allocate down to research, You take the total cost of research. You get to subtract out the modified total direct costs exclusions, the cost of equipment. They don't pay overhead on that. Subcontracts over the first 25,000 of each one. Tuition remission are the main ones. And then that's your ratio, and that becomes our F&A rate. So, then you go and you submit that and you go for a negotiation. So you usually submit a rate at X. They offer you Y and come up in the middle somewhere and during the negotiation phase. So what does the F&A rate bring us? So this is FY16's last time I did the actual F&A rate calculation, so I had all the indirects down to each one of those different cost pools, on campus, off campus, research, other sponsored activities. So we generated $126 million of indirect costs returned that year, and our on-campus organized research was $95 million of it. Our off-campus research was $5 million. Other sponsored activities got another $16 million. So, but if you want to look at our calculation, it was about $180 or $190 million of F&A costs allocated to research. We recover about $100 million of that. So there's the caps. We have sponsors don't pay everything. We have cost sharing that doesn't get any F&A rate because it's our own internal money. So what is our effective return? Even our Fed grants, our rate is at 50, I think in 16 is 56.5. We effectively get 52% of our, we got effectively 52% once you take out their sponsors and pay the full rate. Federal flow-through is about 41. So the type of awards you see, and I think you look back at that financial statement where it said our federal growth was 0.7 and our other growth was 3 point something percent. So our growth in the non-federal, you can see the non-federal pays significantly lower indirects than our federal research. The federal government does partner and pay a higher rate, or generally pays the full rate, except for a few statutory areas where USDA or training awards and things like that. So fringe benefit rates. So uniform guidance also talks about fringe benefit rates. Section 431 is the guiding principles on fringe benefits. They list out what the allowable ones, the regulations you need to do. They also talk about the leave as allowable benefit and how that works. It has to be based on university policy, has to be compliant with GAAP, as we've learned about a little bit earlier today. And the amount that you can recover would be only the lesser of what you funded or what your actual accrual liability is that year. You can't take prior year liabilities, you can't overfund, you can't charge more than what you're going to fund into your liability pools. And then later in that section, they define how fringe rates can be charged to activities of the university. Mostly they're talking about grants. You can do different things for other activities, but they're talking about the federal portion for the most part. So there's two different ways. You could do a discrete identification where each person's actual costs follow that single person, and it goes all the different funding sources. And that's what we did before we went to the CBR rate. And it's a lot more difficult. There's multiple object codes per transaction, every payroll. If someone leaves, you hire someone new. There's all these different things about having actuals. Or you can do based on, you take a pool of costs, and we'll talk about that in the next slide a little bit, and allocate it on the institutional-wide salary and wages for that group of employees that receive those benefits or are eligible to receive those benefits. So the fringe benefit pool that we start with is all the actual costs that the university pays to support our employees. Our health portion of the health, our payroll taxes, Social Security, Medicare, unemployment, all that type of stuff, retirement. So that is the pool. And then the wage base, you define what base of costs of people's salaries are you going to apply the fringe benefit rates to. At KFS, we've had it as pretty much a full base. They're changing the wage base a little bit in PATH. And we could get into PATH later and how that works. Or not. I've had enough on that yesterday. So that really is the same thing as the indirect cost rate. So we have a pool of costs divided by the base, and we get an applicable fringe benefit rate for each group of employees. And then really it works like a big recharge center. You get your actual costs, you charge a rate, you take your over and unders, carry those forward to another year, and you adjust the rates. So it's just always an annual adjustment of rates. Going back to these get submitted to the government on an annual basis, they review it and approve it and set this forward. So some advantages of CBRs, fringe benefit rates. The cost accounting standards that are added to or part of the uniform guidance require a consistency in how you allocate costs, how you budget and charge costs for federal governments. So if you have a consistent rate of budgeting when you submit proposals and you charge the same rate, it helps with those cost accounting standards. Without that, you have to kind of try to get to an average rate for those type of employees. Things can change, so your budgeting to charging is a little bit different. It makes things a little more difficult. It's easier to budget. You know the actual costs or what your charges would be. It doesn't matter if someone comes and goes, the same employee will always have the same rate. The same class of employee was always going to have the same rate. When we did this, it allowed the budget office to decentralize the fringe benefit pool several years ago, like about 2012 or 2013, I think we did that. It standardizes the benefit rate across classes of employees. So an employee with a full family versus someone single, they're doing the same job, it costs you exactly the same, fringe cost. And it simplifies the accounting. We're doing one object code to pay for 17 different types of fringe benefit costs. So on cost transfers, on your ledgers, you're seeing one charge, not all the different ones for all the different object codes or different type of expenses we have. And with that, it decreases the administrative burden. So when you're transferring things, you're not transferring a ton of all of those 17 different object codes, we're transferring one. It's a percentage of everyone. So every time you have that salary, that exact same percentage is going to charge everywhere it goes.